Hello, in this video we'll consider payments from partnership to partner. Now there's three types of payments that you need to know about. There's three types of payments. On this slide I only have types 1 and types 2, and the reason is because these are the main types. Type 3, which we'll talk about in the next slide, guaranteed payments, is a hybrid of types 1 and 2. It's important to understand on a continuum you have type 1, which is known as the partner's distributive share, which is treated as a normal distribution with respect to the partnership interest. And the key is that the taxation occurs in the year of allocation, so we use allocation under section 704, so we apply the general rules. Now, the second type, which again, opposite side of the spectrum, is a payment to partner for services where the partner is not in a partner capacity. An example of this would be, let's say we have a real estate partnership. All the partners are realtors. Now, one of the partners is also a lawyer. The partnership deals with only real estate activities, showing properties and whatnot, that kind of those activities. Well, it happens that let's say the partnership gets sued, and one of the partners is a lawyer. Again, the partner is not a lawyer with respect to the partnership, but they are a lawyer outside the partnership. So let's say they have their own law firm. Well, let's say the partnership hires that partner, not in his or her partner capacity, but as a lawyer outside the partnership to represent the partnership, and they pay them. That would be exactly what we have here. It's treated under section 707A1. Now, I just want to give a general summary. So number 1 and number 2. So we have number 1, number 2. So number 1, the character. So first, the character of the income. So number 1, which again is the partner's distributive share, is a flow through. It flows through. So in a previous topic, we talked about this. The character flows through the item. It flows through to the individual partner, whether it's separately stated or it's considered that bottom line income or loss. Now, number 2 is either going to be, which is the not in the partner's capacity, is either going to be ordinary character when the partner has to pay, when the partner receives it, or capital. So, or capital in nature, depending on what you have there. The accounting method. So the accounting method used depends on which classification you're under. So we'll say method for accounting method. So under number 1, you always use the partnership's method. So what do I mean? Let's say a partner is a cash method partner, right, or lawyer in that example, right? But the partnership is an accrual method. Well, if it was a partner's distributive share allocation, we apply the partnership's method, accrual method. But number 2, where the partner is not in his or her capacity as a partner doing services, it's actually the partner's method. And because it's the partner's method, it's subject to Section 263 capitalization of certain costs. Section 263 capitalization of certain costs. Versus the distributive share is not the case. That's number 1. So the third type, the 707C guaranteed payment, is somewhere in the middle, and you're going to see it's going to have a mixed character. It's going to have some mixed character with respect to these items. So let's go ahead and talk about that. So this is a guaranteed payment. This is number 3 on the continuum, somewhere in the middle, because it has a hybrid treatment. We call this the hybrid. So this is where the partner is acting in a partner capacity. It's not that it's not in the partner capacity, it's actually in the partner capacity, but it's not it's independent of the partnership income. So maybe they're doing, maybe they get some type of salary, and they're doing more work than the other partners. So with respect to how it's treated, we have to look again, it's a hybrid. If you go back to our previous slide, you'll see that number 1, the partner's distributive share with respect to character was flow through, but number 2 was ordinary capital. Couldn't be any other treatment. And the method, number 1 was partnership, number 2 was the partner's method. So with respect to the method of accounting, a 707C guaranteed payment uses the partnership's method of accounting, so it's more like number 1, the partner's distributive share, where we apply section 704. So for example, if a partnership is accrual method, a cash method partner would actually use the accrual method with respect to the partnership's amount that's paid to him or her. Now, the guaranteed payment is always ordinary income. Always ordinary income. It does not flow through. So that's kind of different from both. That's kind of different from both both types. So if you look at the character, it's just ordinary. It's not ordinary capital or flow through. It's simply always ordinary. Now the partnership can deduct, and note that number 2 also, where a partner is not in his or her capacity, the partnership can always deduct because it's as if you're paying a service provider. The business is providing, which ordinary, necessary, paid, or incurred. As long as it meets all those, it can be deducted. So that's fine. Now, with respect to 263, remember that number 2, section 263 capitalization applied, but it did not apply to number 1, the partner's distributive share. Well, section 263 does apply to guaranteed payment. So that's where the hybrid comes in, because 263 applies to 707C, right? So this is more like, so the partnership's method of accounting is more like the 704, which is number 1. 263 is more like number 2, so that makes it a hybrid. And then it's always ordinary somewhere in the middle, right, between the two. It's neither, that's neither the rule. The deductibility, though, is more like number 2, because number 1, the partner's distributed share cannot be deducted. Now, the recipient cannot be an employee. If it's an employee, then that's different. Cannot be an employee. They have to be a partner in their partner capacity. That's the key. All right. So let's go through some basic examples. So here's the normal distribution. So this is number 1. This is where we have number 1. So A is a realtor and B is a lawyer. They form A-B partnership as equal partners. Each contributes $500 to acquire rental property. So the partnership has $1,000 total. A manages property. B, though, is mostly inactive. A and B agree to share profits 2/3 to A, 1/3 to B, because A is doing more work. They're managing property, even though they contribute the same. The partnership earns and distributes $75 from rental activity. A reports $50 of ordinary income. B reports $25 of ordinary income. How did I get that? 2/3 to A, 1/3 to B. The character of rental activity, if you recall, from basic income tax, rental is going to be always ordinary. Royalty is ordinary in nature. The partnership earns and distributes $60. So this is an addition. So these are the 2 types of income. They have number 1 type of income and number 2 type of income. The partnership earns and distributes $60 of capital gain. A reports 40, right? That's 2/3, and B reports 20, 1/3. So the idea here is that the activity 1, activity 2, it flows through the character. We have a flow through of character using our rules, our profit ratio, which means we allocate. This is the allocation rule. So again, this is the partner's distributive share. Number 1, example, partner's distributive share. So example 2, this is method number 2, where the partner is not in a partner capacity. So same as example 1, except the tenant sues the partnership and partnership hires B, which is the lawyer, right? The B is a lawyer to defend the partnership. Now the partnership, remember, was in the business of managing and renting out property, was not in the business of representing clients and law firms. But because B is a lawyer, how convenient, right? So let's just go to B. Now the partnership is going to pay B $9 for doing the legal services. So the partnership earns $75 of rental income and has a $9 legal expense, which nets out to $66 of ordinary income. So remember that when we do distributive share, we have to net these numbers. So 75 minus 9 is $66. So the 9 being that the partnership can deduct because it's an ordinary necessary amount with respect to its business, right? It had to defend itself in the lawsuit because it has ordinary necessary, and it's also paid in the year carrying on the trade or business, right? Because it would not be able to continue if it had, this judgment out there, and then it's possible it could be shut down. So $66, 2/3 gets reported to A, because that's, again, if you go back to the previous slide, we're going off the same numbers. That's the profit ratio, right? And 1/3 goes to B. So that's the ordinary income part. That's the rental property. That's the rental amount. Now, B also has to report $9 of ordinary amount because that's the legal fee. So B adds on the $31. By the way, I know in example 1 there was that $60 of capital gain. That's not in this example. So it shows you the actual result. A has to report $44 of ordinary income. B has to report $31 of ordinary income, which is the 22 plus the 9. The 22 coming from the rental activity, right? That's the 704. That's actually allocation. That's actually number 1, the distributive share, right? Using the profit ratio. And the $9 comes from the number 2, where B is not in his or her capacity as a partner. So that is number 2. All right, so what if instead the partnership earns $75 of capital gain and has $9 of legal expense? So A would report 2/3 of the amount. Well, guess what? Because you can't net capital gain with ordinary loss, right? You can't do that. We'd have a $50 capital gain and a $6 ordinary loss. That's 2/3 of the amounts. B reports 1/3 of those amounts, but then also has to include, this is ordinary income, $9 legal fee in there. So it nets out to $25 of capital gain and $6 of ordinary income, because it's the 9 has to report minus the 6 gives you 6. The 3 being the 1/3 of the 9 legal, because the partnership gets to deduct that. So that's if you change the facts. So that's a change in facts in example 2. Okay, so example 3 is a guaranteed payment. So after several lawsuits, A and B amend their agreement. So they're saying that, okay, A and B, real estate partnership, they manage property and whatnot, but now, because there's several lawsuits, they're going to amend it, and they're going to say, A is going to continue to manage the property, but B is going to provide legal services. There's been so many lawsuits that B actually should serve his or her role as a lawyer. Now A and B will share everything equally. So the tables have changed. Now everything is 1/2. So if we apply to example 2, the first one, right? The first fact pattern, which is this one right here. So same as example 1, right? Where there's a $75 of rental activity, but there's also $9 paid to the respective to B. So now everything is 1/2. So it's the same. The application example 2 is the same. So it's the same result. All right, we have the same result where A reports. Well, I say the same result, meaning that A is going to report 1/2 of the ordinary income. Right, so there's 75, right? So A reports 75 minus 9, which is 66. 66 times 1/2 is 33. So A reports $33 of income. B is going to report the 66 times 1/2 equals 33 plus the 9, so 42 of ordinary income. 42 of ordinary income. Now the difference is, again, is that you look at the method of accounting. You use, the distinctions between example 2 is use the method of accounting, use the accrual method, not the cash method. Guaranteed payment is always ordinary income, so there's not going to be, so if it was ever capital, no, it's ordinary. And then the recipient cannot be employed, we saw that. So the rest of these slides deal with disguised payments, which are actually beyond the scope of this discussion. You're welcome to see this. Basically, disguised payments deal with where partnerships and partners will try to disguise it as actually being like number 1, because it gets better treatment. All right, like number 1, because it gets better treatment. So that basically creates an issue with respect to tax purposes and how it's treated. So you can consider those, but I'm not going to really go into that. So that's really the end of our discussion.